The Indian Railway Catering and Tourism Corporation or IRCTC charges a convenience fee of Rs 15 plus GST for bookings in non-AC coaches and Rs 30 plus GST for reservations in AC ones when someone books the ticket online. On Thursday evening last week, the government announced it would take 50% of the total convenience fees collected. The next morning, the shares of IRCTC nosedived, falling as much as 30% in its steepest intraday decline since 2018 listing. The shares recouped most of their losses and ended 7.5% lower after the government reversed its decision. This, in a way, signaled that the government would keep the interest of minority shareholders in mind while taking policy decisions with respect to listed PSUs. At present, the government's 67.4% stake in IRCTC is worth Rs 45,600 crore. Over the past year, the IRCTC stock, a favorite of retail investors, has gained more than 200%, though it is down 30% from all-time high. The company earned Rs 299 crore in convenience fee in 2020-21. Collection from this segment was lower as online ticket bookings fell 43% last fiscal due to pandemic restrictions. In the non-pandemic year of FY20, it had earned Rs 350 crore in convenience fee, so the move by the government would have garnered it a revenue of just Rs 150 to 200 crore. Last year, about 35% of IRCTC's revenue from operations came from convenience fees, but more importantly, the fee contributes significantly to the company's operating and net profits. Before 2014, there was no sharing of the service charge between IRCTC and the Indian Railways, though the government decided the amount of the charge. The sharing started in 2014 in a ratio of 80:20. The ratio was changed to 50-50 in 2015, but the charge itself remained withdrawn for 3 years from November 2016 to encourage online bookings after demonetization. It was restored in September 2019. Raising the service charge is more difficult as that would translate into higher ticket prices. Although the government managed to arrest the value erosion in the IRCTC stock, the controversy could weigh on the investor sentiment towards PSU stocks, most of whom already trade at a significant discount to their peers. Policy uncertainty remains one of the biggest risk factors when it comes to investing in PSU stocks. This is not the first time that the government's move has worried minority shareholders. It has earlier sucked out cash from large PSUs by way of increased dividends from companies like Coal India, Bharat Petroleum, Indian Oil, and NTPC, to name a few. To raise money, it has also sold shares at a huge discount to the market rate in the offer for sale. In 2012, the government issued a presidential directive to Coal India to force the company to sign fuel supply agreements with power plants. Decisions like these have led to the loss of market value of PSUs. More recently, the Oil Ministry last week asked state-owned ONGC to give away 60% stake as well as operational control of India's largest oil and gas producing fields of Bombay High and Bassein to foreign companies with a view to increasing productivity. The two offshore fields account for 2/3 of ONGC's current oil and gas production. Without these assets, the company will be left with only smaller fields. Will the IRCTC episode send a wrong signal to the investors ahead of the listing of Life Insurance Corporation of India, as the government is known to interfere in PSU affairs? To understand the risks of investing in PSUs and how the government's adventure with IRCTC might impact investor sentiment, we spoke to Aditya Shah, Chief Investment Officer of JST Investment.
First, really understand what did the government do in IRCTC. Back in 2015, there was a similar revenue sharing model that the government had introduced before the company was listed, where 50-50 revenue sharing was taken by the Ministry of Railways. But it was ended in 2015 and 2016, where because you go to the capital markets and capital markets do not accept these kind of mischiefs that a promoter does, this was really ended. That is the first point that is out there. Second point is, how does this would have hit the revenues, since the government has now taken this back under immense pressure from the social media and the investor community. It would have taken off 30% of the revenue and ultimately 70% of the EBIT, that earnings before interest and tax that the company used to make. So it was a massive hit for the company. The valuations would have shrunk dramatically for the company. Look, over the last 10 years, the government has abused the minority shareholders. It continues to pull out money from PSU companies that are out there. There should not be any doubt about it. If any private promoter or public promoter tries to violate the rights of minority shareholders, the government or the market does not take it very kindly anytime. You can look at Vedanta. Vedanta is a prime example where the minority shareholders were violated and the stock was beaten down. Right now, it has moved up because of the metal cycle that has moved up. But the promoter risk will always remain on the PSU companies that are out there. There should not be any doubt about it that PSU companies will be on and off wealth creators. They will be very cyclical in creating wealth that is out there. PSU companies have been the best wealth creators over the last 6-8 months, 1 year. But the point is, they are great businesses, but you never know with the promoter is. Promoter can do XYZ number of things that are out there, which is very, very difficult to predict. And valuations will come down. Not really. Don't think so as such, because this is a bull market. This is a raging bull market with excess liquidity that is out there, which is causing a lot of these stocks to spike off. The fact remains, these are great businesses. Number one. Number two, promoter risk will always be there with these businesses. It will not go away. But does that mean that LIC ka valuation will get affected? Absolutely not. LIC, this IRCTC fiasco should not be a problem as such for LIC, because LIC is the number one insurer in this country. When you come to life insurance part of it, the private insurers are coming in, but it will take some amount of time, at least next 10-15 years, for them to take away significant amount of market share from them.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.